everyone, I'm Andrew with Jesani Wealth Management. And if you're somewhat familiar with options, there is a strategy called a straddle. And it could be a bull straddle or a bear straddle. But essentially what you're doing is placing a bet on the future volatility of either an index or a stock by buying an at-the-money call and an at-the-money put at the same time. Now, of course, option strategies and trading options, most of us don't, have enough time in the day to monitor these trades. So there is a product called a dual directional note, which this is a type of structured note. So a lot of the qualifications are very similar to a structured growth note, which I did a video on, which you can certainly find on our YouTube channel. But a dual directional note is really you're putting a window out to a certain timeline, which can be 1 year, it can be 2 years, it can be 3 years. They're all available based on what the investor is looking for. But that is going to give you all the upside if your underlying index or stock is higher, but also give you upside if that underlying stock or index is lower up to a certain amount. And that's what a dual directional note is. Now, it's important to know that any structured note is not principal protected, right? At the end of the day, this would be a replacement to owning the S&P index or owning a group of stocks, which if you own stocks, you know that they can theoretically go to zero and you could lose all of your principal. Structured notes are no different. So these are by no means a risk-free investment. However, certainly you're mitigating some of the risk by having the downside, what's called a barrier. So this chart is explaining a dual directional note. So on the bottom here, we're looking at the return of the reference asset. So for explanation's sake, let's say that on this particular note, the reference asset is the S&P 500. And let's just say this is a 2-year note, which is what we have been using over the past year. So everything is based off of the return of that reference asset on the maturity date of the note. So we'd be looking at the S&P, we buy the note today, 2 years time from now, what is the return of the S&P? Now, if the S&P return is higher, if we have a positive return, which is shown right here on the upper right, there's usually a leverage factor that the investor gets. So typically the leverage is not as high as you might see on an ordinary growth note, which they can be 150, 160, 170% of what that index performs. But in this particular scenario, let's just say you get 110% uncapped of the upside of the index. So this is a way where if the index is higher in 2 years, great, you get all of that upside plus another 10%, which we all know it's very difficult to outperform the indexes. This is one way to do that. But the interesting part comes into play on the downside barrier. Now, barriers can be at different levels, and I'll circle back to that in a moment. But in this particular scenario, this note had a 30% downside barrier, which is illustrated right here on this slide. So if the index at the end of that 2-year period, in this scenario the S&P, is negative, anywhere between -1 and -30, the investor would actually receive an inverse positive return relative to the level of negative return. So let's say the S&P is -10% in 2 years. Investor would receive positive 10%. Let's say it's -26%. The investor would receive positive 26%. But once the index is down an amount greater than the barrier level, in this case 30%, for the investor it's just like if you own the index. You're down that amount. So let's say at maturity in 2 years, the S&P is down 32%. In that scenario, as an investor, you're going to be down 32%. Let's say the S&P is down 80% 2 years from now. Well, you're going to lose 80% of your investment and only get 20% of that investment back. But this is a way to put a window out 2 years where if the index is higher, you get all of the upside. If the index is lower, up to the barrier amount, you still get a positive return as an investor. Now, these come in all different shapes and sizes. Certainly, you always want to go with the uncapped upside. We don't want to use any notes that have any type of caps. But you could also get a downside buffer, which is a little bit different than a barrier. So let's say this note here, all else the same, had a 30% downside buffer. In that case, let's say the index is down 32. Well, in a barrier, you'd be down 32%. But if it was a buffer, investor would lose 2%. If it was down 40, the investor would lose 10. Now, certainly there's a trade-off for that. You're probably going to have less upside leverage if you got a buffer to the downside. Alternatively, you could get a lower barrier amount, let's say 15%, where if the index is down -1 to -15, you get a positive return, and you could get more upside leverage. So typically what you want to do is ladder these notes in with different maturities based on different indexes with differing amounts of upside leverage and downside barriers. Right now, we really like a barrier anywhere between -15 and -30, while also getting the highest amount of upside leverage available. And the terms on these notes are going to change from week to week and month to month based on the volatility of the market. The banks that are issuing these notes are using options and derivative strategies to create them. At the end of the day, though, this structure and this return is a guarantee of the issuing bank. This particular note was issued by RBC, but all the major banks issue notes every month similar to this. Banks like Citibank, Bank of America, BNP Paribas, Goldman Sachs, JP Morgan, Morgan Stanley. So your other risk, other than breaking the barrier, is that the issuing bank becomes insolvent because this is a direct obligation of the bank. So you have two risks there. One, the bank becomes insolvent, or two, the underlying index declines by more than the barrier, and you can theoretically lose 100% of principal. But you are mitigating some of the downside risk by use of this barrier, and in fact, you get the inverse positive return and also increasing your upside potential. So these are called dual directional notes. Sometimes they're also referred to as absolute return notes. Very important to stay away from any notes that may have caps. Certainly you want to look at the credit ratings of the issuing bank. But if you'd like to know more about these types of notes or what's available at the current time based on current market volatility, you can certainly reach out to us at Jesani Wealth Management. Thanks, everyone. Have a great day.